Good afternoon, folks. Thanks so much for tuning in on what will be our last weekly webcast for 2021. It's been a very interesting year, certainly been an interesting few weeks that we've been going through recently. And what I thought I'd do is do a quick roundup as to what's been going on and how it may be impacting us. We are in the thick now of the Omicron variant. And certainly the caseload has been going higher. There's been some spooks in the market, and so I thought it might be a good idea just to do a good circle up. And then, of course, if you've got questions, please don't hesitate to type them into the questions section, and I'll try and address them afterwards. And hopefully we'll have a good roundup. I got a lot of stuff I want to go through, so I'm going to start sort of right away, and we'll try and wrap this up in 35 or 40 minutes. So just to start from a high level, we continue to be in a structural bull market in equities that started in 2013. That's pretty clear. And we've been going through a generational bottoming in interest rates. So we've been very clear to say what works during falling interest rates isn't necessarily what happens in rising rates. And so far through the year, bonds have been selling off pretty steadily with some interruptions. But certainly this is an aggregate bond index, which takes into account a whole range of issuers and a whole range of maturities. But certainly bond prices are moving lower and have given negative returns over the course of the year. From a commodity standpoint, we've talked all year long about the fact that the commodities have been going through a generational bottoming also, and moving from a structural bear market to what is likely a structural bull market, one that will last for years. The 10-year returns at one point this year were minus 10% a year for the previous 10 years. And while commodity prices have moved higher and the 10-year returns have turned positive, it's still very, very early stages, and this could likely go on a long time. We've talked about the fact that we are seasonally into a stronger period for equities. And that from November to March or April, it tends to be that we get some good strength, but certainly we do get some bumpiness in November and early December, which has been typical. And we've certainly had that this year with the reemergence of the new variant. But we are now at the point during the year where the seasonality does turn favorable. And it turns favorable, especially favorable, from about the middle of December on, and certainly last week was a bumpy week, and today was a very, very good day. Certainly something to talk about there. If we look at the S&P, you can see that we right around U.S. Thanksgiving, after coming out of our seasonally weak period, the COVID variant hit, and we had a shot down in the S&P down to the 50-day where we held. That was December the 3rd was the low point. And then we rallied back toward highs. And then over the last week, took another shot down and retested the low from December the 3rd. And that's something that we often see happen when you go through a corrective period. Market goes back and tests to see whether, in fact, maybe we break down and go lower. That has not been our base case. Our base case was that we were likely to see markets start to shape up. We know that inside the S&P, the average stock at about the worst point was down about 14% off the highs, which is typical for sort of a correction that we might see in a bull market. And we didn't think that it was going to be more than that. As we sit today, there's an important observation to make about this week. On December the 3rd, when the market bottomed, and then when we came back and came on the spider within about 1 point of the low, what is interesting is from a volatility perspective, volatility peaked on December the 3rd at 36. That is a measure of traders' bearishness or concern about increased volatility. When the market retested the lows this week, one of the things that really stood out to us is that volatility didn't come close to retesting the highs. So that to me is a non-confirmation. When the market goes back to lows, but volatility does not spike or in fact exceed the previous high, it means that people have become comfortable with the thing that the market is most concerned about, and does not expect it to go a lot lower. But certainly internally within the indices, outside of some of the biggest stocks, some tremendous damage. The Nasdaq has been particularly hard hit. Nasdaq 100, not so much, down about 7.5% from the high, but 73% of companies in the Nasdaq at this point last week were down 20% or more from their highs. So lots of damage, specifically in companies that are not profitable, that are long on promise, short on earnings, some of the more concept-driven stocks. And the NASDAQ 100 was held up by some of the very largest cap names, which are the cash flow generators, which really have been the ones that we've been most focused in. There's the NASDAQ Composite. It was down 8.5% at the low point. In fact, you can see here that the NASDAQ Composite did undercut the previous low, which just highlights the fact that NASDAQ has been internally quite a lot more vulnerable than large cap S&P 500. When we look at the percent of stocks trading above their 200-day moving average, while the index was moving higher, the percent of stocks trading above their long-term moving averages were falling. And of course, we dropped down to around 30%, which is often where things bottom out. They don't always. But certainly NASDAQ, continues to look a little bit less favorable than S&P 500. If you take out the 5 biggest stocks in the NASDAQ, pretty actually kind of a negative year for technology as a whole, or the unprofitable tech anyway. Here is a representation of that group. This is the ARK ETF. This is Kathy Wood's ETF that invests in what she considered to be the most innovative companies in the market. You can see here that from February, when it started to consolidate or correct, the ARK ETF is down 43%. So those would be the companies we were hearing about in February and March that the new retail investors were chasing after, companies like Peloton and Teladocs and so on. They've had a very rough end to the year and certainly have been under tax loss selling pressure coming to this point anyway. So equally weighted S&P actually put in a significantly higher low than it did on December the 3rd. That's very strong. We had a number of days over the past while where it outperformed the S&P with the large cap names included. You can see the relative strength line was rising over the last short while. So 2 weeks ago, all of our indicators were negative. And it was, a concern, something that we were watching very closely. What we said was, in a period where the percent of stocks in uptrends has been falling and where our short-term indicators are negative, we're particularly diligent at using our stop losses to make sure that each of our individual positions stays within trend. It doesn't mean that stocks don't pull back. It just means that if they don't break trend, we stay in them. If they do break trend as defined by a point figure chart, we make our exit. And we continue to monitor for change. And as we sit today, it's a different picture. Our NYSE model turned back positive 2 weeks ago. So the percent of stocks in uptrends started to rise again. Doesn't mean all of them did, but certainly some of them. The percent of stocks with positive weekly price momentum turned positive. So in other words, companies that had been consolidating over the last few weeks, some started to reaccelerate to the upside. And the percent of stocks making new highs versus new lows also started to improve. So there's still room for improvement. It's still something to monitor, but at the margin, our breadth models, which measure the internal health of the market, have been showing some improvement over the last few weeks against what was a very weak picture, specifically in the NASDAQ. So we'll talk a little bit about data. The data picture really isn't changing the points that we're watching. We've certainly been watching Omicron. When this emerged right after Thanksgiving, there was no information. I think that you could say that there's still not very much information, but there are indications. Certainly it's spreading very quickly. If we look at the Delta wave took 50 days to hit a peak. It looks like the Omicron wave could hit a peak in 25 days. So it may burn very hot, but it may burn out quickly. The second question is how virulent it is and whether in fact this is having a big impact or not. We can take a look here. These are some indications from South Africa, the 7-day average of COVID statistics in South Africa. This is the wave that has hit. Obviously, it's risen very, very quickly, but note that the hospitalizations still are exceedingly low. very different than the trajectory in the previous two waves. Now, doesn't mean this can't start to rise, but the longer this goes on, the more evidence there is that this is a less virulent strain. It's one that may work its way entirely through the population. I know certainly here in Toronto, it's a bit like being in the Battle of Britain. There are bombs dropping all around us. My kids know all kinds of folks who have contracted COVID in the last couple of weeks. And I think that it's raging a lot more quickly than it has in the other waves. But there's less evidence that this is as virulent as some of the other cases, certainly in the breakthrough cases. So CPI we talked about last week as coming in kind of hot. We talked about the jobless claims getting a little bit better, and those are good things. But I think the thing that continues to be on people's minds is inflation. PPI data came in last Friday, very hot. So the business activity was very strong, but the prices paid on finished goods is rising rapidly. When we looked at the NFIB, which is the Independent Business Survey, the single biggest problem that they see is inflation. Now, it's a problem if you're a business that can't pass on prices. It's a problem if you're invested in companies that do well in falling inflation, but get hurt by rising inflation. Not as big a problem if you're invested in companies that benefit from inflation or have pricing power and an ability to take price as their input costs go up. In many cases, they can pass on more price increase than their input costs are going up. But this has been a major theme for us. So inflation expectations out over the next year continue to rise. And this is something that we watch closely. We'd love to see it moderate because certainly that is a better thing for equities. But there are certain parts of equity markets and certainly other asset classes like commodities in particular that benefit from this environment. And we can see that commodity prices, so commodities less food and energy, so things like metals have had a very, very sharp rise in price this year, good for some of the producers of those same products. So let's look at some of the indications. This is the 2-year bond yield. It has been moving sharply higher since September. We've seen a series of higher lows, not so great for short-term bonds. The 5-year bond yields also moving higher. The 10-year bond yields were kind of flat, but have held their gains and now seem to be turning higher. Bonds continue to be under pressure. So let's talk equities for a minute. As I mentioned, the indicators for internal breadth continue to show some improvement. Today, we saw it show up in price. So of the groups, the key leadership groups today had a pretty good day. So our job isn't to be everywhere. It's to try and identify the areas of the market that have a structural tailwind, have something changing that could cause them to look better than other sectors or themes and be revalued favorably, meaning prices moving higher, multiples moving higher, money moving into those groups. If in the lack of leadership, we know that sometimes we need to raise some cash, we need to use the stop losses, and we always need to be prepared to make changes to the portfolio because we're getting paid to make sure that we are invested in parts of the market that people care about and are being positively impacted. So let's start from the top. Financials have been a key theme for us. Certainly over the last few weeks, we've seen a little bit of a correction in financial services as a whole. Frankly, it's been, if you look at relative strength versus the market, since the middle of November, it's roughly flat versus the market. So as a group, financials haven't underperformed. They've come in sort of in line with market, but there have been areas of the market outperforming. Certainly the Canadian banks have been outperforming. Relative strength versus the S&P has been rising. And in our top 10 positions, 3 of them are big Canadian banks, and they certainly haven't always been there, but we own them for the dividend growth. We own them for the improved asset quality, and we own them for the return of capital that we think is likely to come to us by way of dividend increases and share buybacks over the next year, and probably beyond that. So Royal Bank of Canada would be in our top 5 holdings. very sharply improving relative price strength versus the market, trading basically at highs. And TD Bank would be our second largest bank weight. I think it's our seventh biggest position at the firm. So these continue to act very, very well. The asset managers have pulled back a little bit over the last week or two. This is Morgan Stanley in capital markets. But again, relative price performance versus the S&P stable. We just pulled back to the long-term moving averages. That's a healthy correction, much like we saw in August, September, October, leading into the November rally in 2020. And I think that we are likely to see the same kind of reacceleration coming out of this concern period around Omicron. Small cap banks impacted a little bit more. Again, this is SVB Financial, Silicon Valley Bancorp. It's a higher growth bank. And yes, certainly pulled back to the 150-day moving average. Had quite a good day today. But I'll just make a note, within the Russell 2000, if you take the Russell 2000 bank index, small cap banks relative to the Russell 2000 have been showing rising relative price strength. So small cap stocks have had a difficult few months. Small cap banks relative to the Russell 2000 are outperforming. And so on a reacceleration in small cap, banks should perform well. And we know that seasonality is very favorable for small cap from about the middle of December through April, especially in a year when there's been tax loss selling, which should be wrapping up around now. Let's move to technology. Technology has been leadership through the course of the year. The XLK ETF is dominated by the very largest of technology companies, so looks a little bit better than the Nasdaq. We had a low around the 3rd of December. We had a higher low this week, and today, had a nice reacceleration. But when we look at our core names that we have in our top sort of 20, Apple is the biggest name in the firm. The relative price strength has been rising sharply over the last 2 months versus the S&P, and certainly versus the Nasdaq. Continues to perform well, basically pulled back to the 21-day moving average. Microsoft also has been a strong performer through the course of the year. This 92 relative strength means it's traded better than 92% of the companies in the S&P 500. And yes, pulled back from $350 to $325, but holding in much better than tech in general, while software in general has been relatively underperforming. So software has been a group that we have in general avoided. We've got 3 positions in the group. All are behaving well, much better than the group. Semiconductors. Semiconductors have been strong through the course of the year. We're trading very close to the highs, about $20 off the high for the XSD, which is an equally weighted basket of semiconductor companies. You can see here in the list, these are all about 2.8% of this underlying ETF. Where we rifle shot, the very largest semiconductor position we have is Broadcom. It's had a very, very good 3 months, and today, really traded at a new high. Cisco Systems is in the telecom equipment group. Interesting, within tech, the large, mature telecom equipment companies, the companies that build the equipment that runs the networks and the internet, are performing exceedingly well. And actually, this group has had a very nice consolidation, and we're making new highs in Cisco. So tech continues to be an underweight for us, but large cap cash flow generating tech companies are behaving still well, and they've been a contributor to the portfolios. Let's move on to energy. Now, this is the ETF that encapsulates the Canadian oil and gas producers. So relative strength versus the S&P continues to rise. And it's interesting because oil actually has had a pretty good pullback relative to software until September of this year. And we know tech was leadership through the course of the year, but you can see that energy relative to the software sector has started to outperform. And we're looking for themes that can be revalued favorably. Now, I recognize that energy, carbon-based energy, doesn't fit in ESG portfolios, so socially conscious portfolios. But the reality is, until we can build out a lot more infrastructure in the electric grid and solar and alternate sources of energy, we're going to need carbon-based energy. So our job is to generate a return. The carbon-based energy companies have been underinvesting in new capacity, which is why we have a shortage. And for the near term, these companies should generate an enormous cash flow, buy back lots of stock, pay down debt, and increase dividends. So our largest waste would be Canadian Natural Resources, which has, as you know, close to 100 years of reserve life. They've invested billions of dollars to bring the capacity to where they are now, trading better than 93% of companies in the S&P 500. And on the gas side, Tourmaline is one of the last few large gas companies standing, and again, has held in very well relative to the market. Often when the market corrects, the higher beta or higher volatility energy sector would pull back more than the market. If we really thought the economy was slowing down, energy would really underperform, but you can see these companies hanging in very well relative to the index itself. And so on a reacceleration, we should see some good strength. Let's move on to industrials. Industrials consolidated from January through September. They turned higher, and they certainly did pull back a little off that over the last couple of weeks. It's a highly economically sensitive group and one that we keep a close eye on. We talked about how profit margins are moving higher, but in the rifle shot positions that we have within industrials, they continue to perform well. So Textron is in the aerospace business. They make assemblies and sub-assemblies that go into a lot of the defense contractors, and they have their own the helicopter business themselves, trading very close to the highs. Relative price performance from the S&P has continued to behave well. It's up 4.5% today. General Dynamics, also in the same group, performed well. Another one of our large names. And I did get a question this week on Canadian National Railways. As you may know, they had lined up a new CEO. He decided not to take the position. The market didn't like that very much. Stocks pulled back into the 150 and 200-day moving average. This really is a company that is not extended. It consolidated through the period September through August. So basically a full year before reestablishing an uptrend. It remains in an uptrend. I'm sure that this management issue will be resolved, but in the very short run, went into the penalty box this week. Continues to be in our portfolios. Okay, materials. Now, we talked a little bit earlier about the fact that we think that commodities came out of a structural bear market about a year ago. As you can see, the moving averages are slowly working their way higher. That's the 200-day, 150-day, and 50-day moving average. This is a group that does get negatively impacted if there's concern around economic growth, and certainly a new variant would be a concern that it might slow economic activity. I do note that when the market made its low on December the 3rd, the RJI, which is a basket, an unweighted basket of commodities, made a low at the 150-day moving average. This week tested a higher low and had a very strong day today, especially in the companies that produce commodities on the back of the first sign of strength. So this is something that is significantly impacted by the US dollar. Now, our call longer term is for a weaker US dollar. Now, not just versus Canadian dollar, but versus euro and yen. As people are willing to take risk, they take defensive assets and they put them into productive assets. And you can see that the US dollar has had a rally off the lows. So my guess is this is likely to roll over. It's not likely to last. But in the short run, when you price commodities in US dollars, it will have an impact if the US dollar rallies. What I can say is if you take the last 8 cycles where the Fed started to tighten, as soon as the Fed started to tighten, the US dollar started selling off. Now, the Fed's been very clear in the last few weeks. It is time for a Fed tightening cycle. First, they are reducing and exiting from their tapering from their quantitative easing. And next will be to raise rates. The expectation is 3 rate hikes going forward in 2022 and further rate hikes in 2023. We think that there's been anticipation of that causing some strength in the US dollar, but it's buy the rumor, likely sell the news. And the US dollar had a little peak in November. It retested that peak in December. Looks like it's rolling over, hasn't made a new high since mid-November as we were getting ready for that Fed meeting. So we'll see. But the companies that we have in this group are continuing to perform just fine. Nutrien would be our largest weight in basic materials, made a new absolute and relative high versus the market today. From a copper perspective, we've talked about the fact that copper, which is the single most important metal if we are going to electrify the world, came out of a long-term bear market at the beginning of 2021 and then consolidated. And if we look at sort of what's happened in the meantime is after that initial run, we've had time for the market to cool down and the speculators to reduce their positions. When the speculators are overly long, often you'll get a correction. And when they're done reducing their weights, you can often see a reacceleration. So if we look at Freeport-McMoRan Copper and Gold, probably the most important copper producer in the world, after breaking out, consolidated in October, started to lift again, has moved sideways. And during a time when the market pulled back over the last 4 weeks, actually Freeport is up during the period. Again, another sign that's highly likely the market is not making a bet on slowing economic activity, because if it was, certainly copper would be selling off. But this is a very important copper producer. It looks like it's just starting the next move higher. And if we put it in really simple terms, going back to 2014, we had made a low in 2016. We made a higher low in 2020. We broke out, we consolidated. These are monthly bars, consolidated over 4 or 5 months, and it started working its way higher. So I think we are in the very early stages of a reacceleration in the metals companies. And that's not just Freeport. We're seeing improvement in Vale, BHP, Rio Tinto, and of course, Freeport-McMoRan. When we take commodities as a whole and compare them to equities, they don't always work together. We had a low in commodities around the peak in the Nifty 50 boom in stocks, and then they rallied for the next 10 years. We had a relative low around the time tech stocks peaked out in 2000, in the year 2000, and they rallied into the financial crisis in 2008. And we've made a relative low in the last year. I think that's going to be an important low, and it's likely that we see commodities as a whole perform well going forward. Now, let's move to the consumer. 70% of the U.S. economy, the consumer discretionary sector. This is an unweighted basket of consumer discretionary companies, started to accelerate in October, November, certainly got knocked back by, again, by Omicron, retested the lows as of yesterday, again, a higher low. That's very encouraging. A decent day today. When we look at some of the exposure that we have, Ford didn't move a muscle lower. Our holdings in Costco and Target performed extremely well. The home building group, the home building construction materials and home builders themselves certainly pulled back a tiny little bit, but look very, very constructive. There's Century Homes, which makes lower priced homes specifically to be sold to a sort of a first-time home buyer. We know the millennial generation are starting to buy homes, and they're doing it because they're starting to have kids. We think that this is much like the early days of the baby boom. The millennial cohort is bigger than the baby boom cohort. And if you think back to 1975 on, the baby boomers at that point started to move into adult life and buy homes and buy cars. Well, it's a bit of back to the future, homes and cars looking kind of attractive. This is home improvement, Lowe's, and some of the companies that are supplying into the home construction materials also starting to look quite attractive. We talked last week about Reits. Reits made new relative highs versus the market this week. We've been focused mostly in industrial Reits. We've had good luck with Granite REIT, which is industrial properties. The pricing on leases for industrial properties continues to be quite strong. We've stayed away from office REITs, real estate investment trusts. We also have some multifamily residential in our macro portfolio. Consumer staples, one area that did really, really well during the first wave of the pandemic, certainly is having a good lift. We're a little bit careful here. We've just focused more on the retailers themselves. So there's Costco shares, looks very, very strong, trading at the 21-day moving average, strong relative price performance versus the market. And George Weston, which had just a tremendous 2 weeks. We all know that Weston's operate through a number of different units, but certainly it falls into the consumer staples area. And frankly, we own a big position in Loblaws as well. Dividend growth continues to look favorable from an income perspective. We think if you've got rising inflation, you want a rising stream of income. So we're focused on companies with an ability to raise their dividends. We've stayed away from companies with a high dividend, but little ability to grow their dividend. This is SDIV, which is made up of global high dividend paying companies. It's actually down 19% off the highs since June. So we've sort of stayed away from the defensives. If you looked at the strength in the market today, it was dominated by financials, technology, industrials, materials, and at the bottom end of the spectrum, on the first strong day we've seen in a while, very poor performance in the defensive securities. One new area of strength I think we want to look at from an income perspective are some of the commodity producers that are dividend payers. This is an ETF, GUNR. It's focused on upstream natural resources companies. You can see the largest holdings are ExxonMobil, Chevron, Nutrien, Archer Daniels, BHP, Rio Tinto. You get the picture. It pays a 3.7% dividend. And we think with prices on commodities moving higher, that dividend's likely to move higher. I think that's far more attractive than a utility that isn't growing. So, growth versus value. Growth certainly had a nice lift from summer until the fall period. But since November 30th, value has started to outperform. And this, of course, is where we think you get the next major leg. The last time we got a significant peak like that was in the late part of 2000, and that's when the reflation trade really lifted in November of 2020. And so we think we are at the beginning of the next leg in this reflation trade. We've had the differential between high multiple stocks and low multiple stocks start to come down as value is starting to outperform. But you can see the differential between value and growth is a 73% difference. We think that you could see a significant outperformance by value going forward. And we note that the free cash flow yield for the S&P 500, especially X technology, is very, very healthy and gives us a good reason to want to be here. So holdings. Holdings really haven't changed over the last week. Our big weights continue to be financials, and information technology, as you know, is a significantly lower weight than market cap. Energy continues to be quite significant. Consumer staples moved higher as we increased our weight in things like Costco, Weston's, and Loblaws. Industrials is about a market weight. Materials has been rising, and we've been keeping a low weight in some of the more long duration bond proxy type sectors. So just to make a point, we talked about a lot of stocks today. We have a lot of companies that we own. I've ranked our top holdings in the firm. So the very largest weights, starting in dollars, is Apple, Weston, BMO, Nutrien, TD, Microsoft, Royal Bank, Fortis, Canadian Natural Resources, Loblaws, Morgan Stanley. These are familiar names from those that we've been talking about. Broadcom, Dream REIT, Nextera, which we've talked about as being a growth utility, Granite, Sun Life, Google, Bank of Nova Scotia, Costco. So these are the most important positions within the firm. They all fit within these themes. Last few points. We've seen a correction over the last few weeks in cryptocurrencies, but I want to make an observation. When securities accelerate or decelerate, there are turning points. We've just seen the moving average convergence divergence indicator crossover. That's an MACD, crossover positive. And it's happening when Bitcoin has pulled back to the 200-day moving average. The last time we got that crossover was at the 150-day moving average in October, followed by a sharp rally. And previous to that, we crossed over in July, previous to a sharp rally. So my guess is we are just about to reaccelerate in some of these cryptocurrencies. I think it's the same picture for Ether. And I think that 2022 sets up to be a very good year in this area as it becomes an important part of the financial system. So just to recoup, we're in the middle of December. We are into the seasonally strongest period of the year. We are now into the seasonally strongest period of December. From a valuation perspective, equities are generating close to 4% excess return on their capital as you could get on fixed income. In other words, you're being compensated well to take risk. It's not overly expensive. The risk premium is similar to what it's been over the last 6 years. The areas in gray are recessions, where earnings go down and then ultimately earnings come back. So valuations are not excessive. But earnings growth is accelerating. So we have good earnings and strong earnings growth at a time when there's $5.5 trillion sitting in money market funds, getting a 0% rate of return in an environment where currency has been devalued over the last number of months by 6.8%, the inflation rate. So this cash should get deployed. We know that during the fall, money managers raised a significant cash weight, and that likely that gets redeployed on a market reaccelerating. So there is cash both in the hands of money market funds and on the sidelines in funds. We know that earnings are strong and improving. We know that share buybacks that have been announced this year are larger than any year in history. We know we are heading into the 4 months of the year where we get the most systematic flows into equities. And of course, a month from now is the month where there's more inflows than all other months of the year combined. If things were to get more sloppy, our indicators were to get worse, or our themes stop working, we will get defensive. And it's no fun that along the way, we've had the first wave of COVID, we had the Delta wave of COVID, and now we've got the Omicron wave of COVID, but the market has handled all of them. And my guess is if it was 50 days for the peak of the wave in the case of Delta, the market bottomed and rallied well before the peak of the wave. If it's 25 days, because this one is coming more quickly, then we should see the market be bottoming around now and looking beyond the Omicron wave. And I think today was a very important day. All of our leadership teams had exceptional days today and looks as though we're headed into the Santa Claus rally. So we'll continue to update you. There will not be a webcast next Tuesday, but we'll be back right for the beginning of the year. And hopefully we'll start on a good footing. Generally, the first week or two of January are quite important, so we'll watch how they come in. I will note that we come into the end of this year with money managers underpositioned. And after a difficult year for most hedge funds, the average hedge fund is up about 4% on the year. It is likely they are going to be chasing returns early in the year. So that money should get redeployed. So on that, let me just check and see if we had some questions come in. Pam could not join us today. So first question is, what are your thoughts on how forest products and steel companies in Canada will perform in 2022? Will there be sufficient demand to keep prices profitable? So there's a couple of things. First of all, we know that the home building industry in the US looks very, very strong. It's actually probably the strongest group in the market. That means there's going to be continued demand for forest products and certainly for softwood lumber. On steel, we know that the Chinese are trying very hard to initiate some of their environmental controls. They've asked their steel companies not to produce anything more than what they produced last year. And they are implementing policies to try and keep steel within China and not to be exported. So in the absence of Chinese steel, the North American steel companies are likely to have much better pricing power. So we think that as this reflation wave continues, the companies that are making basic materials should get very strong pricing and likely be very profitable. On the question of financials, do we have thoughts on the smaller boutique banks? So specifically, I tried to address that a little bit earlier. The smaller banks pulled back a little bit more over the last month than the very large cap banks. But frankly, you have to compare them to how they're doing versus the small cap index. And the small cap index pulled back on some of those economic concerns, but we're now into the seasonally strongest period of the year, the next 6 months for small caps, and small cap banks significantly outperformed what happened in small cap index as a whole. So my guess is if we like financials as a group, and we think that small cap can have a decent 6 months, we're through any part of the year where there would have been any tax loss selling, or more or less over the next few days, I think the small cap banks can perform quite well. And in Canada, we think that there are a couple that will do that. Home Capital is one that I would name. The last question we had here was on the US dollar index, and if we see it strengthening in a flight to safety. Well, the question goes on to ask, the flight to safety driven by Omicron. So think about it for a moment. We've had Omicron really emerge around Thanksgiving toward the end of November. US dollar made its most recent high early in November, and we have not gone back to those highs despite the fact that we're having an acceleration in the Omicron wave. So if you pair that with the fact that you tend to have a peak in the US dollar around the time when the Fed starts to tighten, and the Fed is just really getting into a tightening phase, and certainly we had some rhetoric around that at the last Fed meeting. My guess is because the positioning in the US dollar is now quite crowded, it is likely that you see the US dollar back off, not strengthen, and that would be supportive for a lot of the more cyclical industries. So those are the main questions. I had a question earlier on CNR, and we'll try to answer that during the presentation. If you got more questions, please don't hesitate to give us a call. We'd be happy to jump on the phone. I'm hoping that everybody will have a chance to enjoy a wonderful holiday season. Please stay safe. I know that the cases are rising quickly, and let's hope that they remain less virulent in this wave than in other waves. I think that in Canada now we have 90% of our population above the age of 15 with 2 vaccines, and about 30% now that have been boosted. I know I got my booster and didn't wait around for that. And let's look forward to the next leg in this market. I always like to say the market doesn't respect a calendar year. So often the correction that we see in the fall is what sets up the end of the year rally, but more importantly, the rally through January, February, March, April, May. And our job is to be ready for it. I know that some of the economically sensitive sectors did certainly pull back over the last few weeks. But we also see that when we get an up day like today, and those cyclicals are up 5 and 6% in a day, you can't afford not to be there when they start to rally if they haven't broken down. And my guess is really we haven't broken down that. Now I see that there's a few more questions here. Hold on. Oh, somebody wished me a happy birthday, which my birthday is on Christmas Eve. So thank you very much for that. I had a question about Boeing and Air Canada being beaten up recently. Well, it makes sense, certainly, that they would pull back some on this Omicron wave. There is some concern around, travel restrictions and so on. I would just encourage those who are looking at those companies. We don't own a lot of them ourselves, but to keep in mind, the market will look beyond this wave very quickly. And my guess is that may happen sooner rather than later. A question about gold not breaking down yet, but hasn't performed well despite inflation. I think that you should be watching gold shares, frankly, over the next couple of weeks. I think that the last day for tax loss selling in the US is December the 27th. And I will note that in the last couple of weeks, some of the gold stocks have started to outperform the gold itself. My guess is we will see that in 2022. But if it doesn't start to catch a bid in January, February, my guess is it will be a larger scale move to the sidelines. It's not what it looks like. The setup continues to look quite attractive. And the last question is, will we continue to do the webcasts in 2022? We absolutely will. And I certainly hope that we're going to have a chance to improve on them. If you got suggestions on topics you'd like to hear something on, I know we plan to do one specifically and entirely on cryptocurrencies, which I believe will likely be the beneficiary of a lot of institutional money finally making an allocation in that area over the course of 2022. So that should be an interesting one. But if you've got topics you'd like us to cover, certainly shoot us an email or give us a call. And as always, thanks very much for tuning in, and we'll look forward to seeing you all next year. Have a wonderful holiday.